You've probably seen the headlines by now. China is drowning in debt. 300% leverage. Systemic collapse imminent. Depending on the channel, this is either the end of the global financial system or the secret weapon that lets China dominate the next decade. And as usual, the truth is quieter, messier, and a lot more interesting than the thumbnails suggest. Today, I want to slow this down, strip away the hype, walk through the numbers calmly, and explain why this so-called ghost debt is less about collapse and more about control. If you're new here, welcome. This is Financial Briefing. We focus on precious metals, macro risk, and capital preservation. No clickbait, no panic, just probabilities, positioning, and a plan. Before we get into China's balance sheet, I want to ground this conversation in accountability, because analysis without a track record is just opinion. Back in late 2022, when silver was trading around $20 an ounce, we said downside was limited unless real rates stayed deeply positive. Silver never broke 18, and by mid-2024, it was pushing 28. That call wasn't perfect on timing, but directionally it held. In early 2023, when everyone was calling for a dollar supercycle, we said the dollar index would likely top between 105 and 107 as U.S. growth slowed. The DXY peaked just under 107 and has since drifted lower into the low 100s. And last year, when fears of a Chinese hard landing were everywhere, we said Beijing would choose stagnation over collapse. Growth would disappoint, but the system would hold. That's exactly what we've seen. Weak growth, rising debt, but no crisis moment. I'm not saying this to brag. I'm saying it so you understand the lens I'm using today. This channel is about getting the regime right, not predicting fireworks. So let's talk about the debt that nobody seems to understand. The first data point is the headline number itself. China's total debt, including government, corporate, and household sectors, is roughly 300% of GDP. Depending on the source, estimates range from 280 to 310%. On the surface, that sounds catastrophic. But context matters. The United States is around 250%. Japan is north of 400%. Europe sits somewhere in between. What makes China different isn't the level of debt. It's who owes it and who owns it. Roughly 2/3 of China's debt sits inside state-owned enterprises and local government financing vehicles. These are quasi-public entities borrowing from state-controlled banks, funded by domestic savings. What it means is that China's debt is largely internal. The liabilities and the assets sit on the same national balance sheet. What it does not mean is that debt doesn't matter. Misallocated capital still drags on growth. Bad loans still reduce productivity. But the transmission mechanism is political, not market-driven. There's no foreign creditor demanding immediate repayment. There's no forced liquidation triggered by margin calls. The second data point is property. Real estate and related sectors account for roughly 25 to 30% of China's GDP. Over the last decade, property developers accumulated trillions in liabilities, many of them off balance sheet. Since 2021, residential property sales have fallen roughly 40% from their peak. Land sales to developers, a key funding source for local governments, are down more than 50%. Historically, this is comparable to Japan in the early 1990s after its property bubble burst. Prices stagnated, debt lingered, and growth slowed for decades. What it means is that China has chosen to deflate its largest asset bubble gradually, rather than bail it out aggressively. This is painful, slow, and politically risky. What it does not mean is an imminent banking collapse. Chinese banks are not marking these assets to market the way Western banks do. Losses are extended, restructured, and absorbed over time. Again, this is financial repression, not free market clearing. The third data point is the currency. Despite all this debt, the renminbi has not collapsed. Over the last 5 years, it's depreciated modestly against the dollar, roughly 10 to 12%, depending on the window. China still runs a current account surplus. It still controls capital flows, and it still holds over $3 trillion in foreign exchange reserves, even after years of gradual decline. What it means is that Beijing retains currency control. Debt hasn't forced a balance of payments crisis. What it does not mean is that the currency is strong. The trend is managed weakness, not appreciation. And that has implications for commodities, gold, and capital flows. So when people say China has turned 300% debt into power, this is what they're really pointing at. Control over time, control over capital, control over pain distribution. Now let's walk through the bullish case, because there is one, and it deserves to be taken seriously. First, centralized control allows China to stretch debt over decades. Losses don't crystallize quickly. That lowers the probability of a sudden crisis and gives policymakers optionality. Second, debt-funded infrastructure has already been built. Roads, ports, power grids. The future capital burden is lower than it appears because the physical assets exist. Third, A weak but stable currency supports exports and manufacturing dominance. That's deflationary for the world, but stabilizing for China. Fourth, slow growth combined with internal debt encourages domestic savings to stay trapped in the system, funding the state at low cost. Put together, this is a model of endurance, not brilliance. It doesn't create innovation miracles, but it avoids collapse. I assign roughly a 25% probability that China successfully manages this debt load without a major financial crisis over the next decade, maintaining geopolitical leverage and industrial strength. Now, the bear case, which is equally important. First, debt saturation reduces returns on investment. Each new yuan of credit produces less growth. That's already happening, and it's a structural drag. Second, demographics are deteriorating fast. A shrinking workforce makes debt harder to service over time, even if it's internal. Third, financial repression transfers losses to households through low deposit rates and reduced wealth. That risks social instability and political backlash. Fourth, external shocks matter. Trade restrictions, capital outflows, or geopolitical conflict could overwhelm even a controlled system. In this scenario, debt becomes a slow burn crisis. Growth stagnates, productivity declines, and global influence erodes. I give this outcome about a 35% probability. That leaves the middle case, which is where I think reality lives. China muddles through. Growth stays weak, in the 3 to 4% range. Debt keeps rising, but so does nominal GDP. The system becomes increasingly state-directed, less efficient, and more inward-looking. There's no collapse, there's no triumph, just a long grind of adjustment. This scenario carries the highest probability, in my view, around 40%. To understand why this feels familiar, we need some historical context. The closest parallel is Japan after 1990. Massive property bubble, enormous internal debt, aging population, central bank intervention. The similarity is the refusal to allow a disorderly collapse. The difference is political structure. Japan operated within a democratic framework and open capital markets. China does not. That difference cuts both ways. China can suppress volatility more effectively, but it also risks misallocating capital for longer. Another difference is timing. Japan faced this in a deflationary global environment. China faces it in a fragmented, inflation-prone world, which brings us to cross-market signals. Gold has been trading in the 2,300 to 2,400 dollar range, reflecting central bank demand and geopolitical hedging. That tells me sovereign risk is being priced, but not panic. The dollar index remains elevated, but range-bound around 100 to 103. That suggests relative U.S. strength, but not a runaway dollar squeeze. The U.S. 10-year yield hovering around 4% tells us real rates are restrictive, but not crushing. Liquidity is tight, not frozen. Taken together, markets are cautious, not alarmed, and that's consistent with the middle case. Looking at positioning, futures data shows managed money long gold, but not excessively so. Silver positioning has rebuilt, but remains below euphoric levels. Banks are net short precious metals, as usual, but within historical norms. Institutional behavior tells me this is a hedge environment, not a speculative blow-off. So here's my personal action plan. And remember, this is not advice, just my framework. If China's slowdown deepens and global growth weakens, I maintain exposure to precious metals as a hedge against monetary response. If real rates fall meaningfully, I add to silver, given its leverage and current spot range around $30 to $32. If the dollar breaks decisively above 105, I reduce risk and wait. Currently, my allocation is roughly 15% precious metals with a heavier weight toward gold than silver. Cash sits around 30%. The rest is diversified exposure. My stop loss on silver is below $27. My take profit zone is mid-30s, around 36 to 38, where I would trim. Again, not advice, just how I'm thinking. Equally important is what I'm not doing. I'm not panic buying headlines about collapse. I'm not doom scrolling fear content. And I'm not assuming any system, Chinese or otherwise, just breaks overnight. Finally, here's what I'm watching this week. First, Chinese credit growth. If total social financing rebounds meaningfully, that's short-term bullish for risk assets, but long-term debt negative. Second, the renminbi. A controlled drift is fine. A disorderly move would change the equation. Third, U.S. real yields. If they roll over, precious metals likely catch another bid. So let me wrap this up. China's debt is massive, but it's internal. Control delays crisis, but doesn't erase cost. Markets are hedging, not panicking. The most likely outcome is slow adjustment, not collapse. If this kind of analysis helps you think more clearly, consider subscribing. It tells the algorithm you value calm over chaos. Thanks for watching Financial Briefing. Stay sharp.